Meredith Whitney knows it's about baseball. In baseball, you go up to the plate, and 2/3 of the time, you go back to the dugout. She has enjoyed over the years a few times of putting the ball in play, definitive in finance, in banking, still Meredith Whitney Advisory Group today. What was it like, the acclaim you had? I'm going to call it 15 or 20 years ago. How did you handle just the day-to-day vavoom of Meredith Whitney, municipal finance and banking? How did you handle it day to day?
It was really awkward because, my world had been really small, covering banks and financials, and I loved it. So people within the industry knew who I was, and I had great relationships. And then all of a sudden, there was so much more attention focused on me, and it's uncomfortable. I wasn't used to it. I can't imagine how you guys get used to it. It was a long time ago.
But you perfectly decide what you and Sally Krawchuk were path-breaking on, which is actually doing securities analysis. And then it got so much bigger than that. Let's show one of the huge Meredith Whitney successes. You got to play, you got to put the ball in play, and then you have to have the courage to hold on. I was in a meeting with Meredith ages ago. I could barely shave at the time. And, there we were, and she says, this company, Visa, it'll work out. When did you sell Visa? When did you get out? How did you not sell Visa?
I mean, it's just been, back then it was just, cash to credit. There was this huge tailwind to it. And also it was like, I call it a demutualization from the bank. So it was a straight arrow. It was one of the easier ones. And I call it the OG of fintech because it was really one of the first fintechs. Mm-hmm. Now, after the financial crisis, the fintechs became a real thing and disintermediated a lot of the things that banks weren't willing to do because they had PTSD from the financial crisis.
Right. You say Visa, I think about credit cards, and I know, Meredith, you track consumer credit as a way to gauge the health of consumer spending and therefore the broader economy. Your view is that it's become increasingly more valuable because of the way that people use credit cards, their Visas, now as opposed to 5 or 10 years ago. What does that look like?
Well, what's happened is post-financial crisis, the banks pulled back dramatically from near prime and subprime. So they had all sorts of exposure. Wells was a big subprime lender. And so all of that has moved into the shadow banking system. Even companies like that were famously subprime, like Capital One, has pulled way back and is focused on prime. Mm-hmm. So instead of revolving balances, people are spending and paying back monthly. Now the balances don't reflect that. They grow, but they're growing at the pace of inflation. And so what I look at as being a very good guide for where inflation is. And when gas prices peaked in early May. Mm-hmm. Credit card spending had already peaked in early April. So, and you've seen credit card spending decelerate from that time. And so these are just people spending, absorbing the higher prices, and then just spending accordingly. So I think the Fed should look at their own data. This is data that comes out weekly, so you can see credit card balances, and it's really helpful. So I think inflation is in a rearview mirror.
So it's like a charge card as opposed to a credit card that you pay the balance off of.
That's exactly right. Okay. The charge plate. You're dating yourself.
But that's also why all these big banks are chasing the higher income consumer. Everyone's coming out with their own premium credit card because the fees are so lucrative. I mean, there's an underserved population here of people who actually need credit cards but can't actually get it.
Can't get it. And so what they're doing is they're going outside of the banking system, which means it's incredibly expensive. I say that people aren't living paycheck to paycheck, but payday to payday. So the fastest growing industry within fintech and financial services is advanced wage pay. So if you've worked 2 days, you can access for a fee your wages for those 2 days. And what happens is people are using this service multiple times. Now, it was Dave and Chime that reported yesterday that it was their fastest growing product. And so while on a 2-week basis, it looks like a 6.5% interest rate, but annualized, that's over 160%. People aren't using this product one time. They're using it multiple times.
It harkens back to our grandparents. It feels like it's almost, depression kind of. It's not about fancy personal finance and retirement. It's about a tough time out there. We're trying to get to the next paycheck.
That's exactly right. So there was a study done in February that 2/3 of people working are living paycheck to paycheck, and a quarter of labor force participants are struggling to pay their bills. And so what they're doing is they're going to pawn shops, they're doing payday earned wage access borrowing,
Right.
and they're tapping into, for the subprime and near prime, they can't even get home equity loans. So this is a feast.
Well, this is the courage you had over decades, talking about the two Americas out there. Help me out as a stereotype of James Dimon of a small bank on Park Avenue and buy now and pay later. I mean, to me, it's almost a revolution where the kids aren't using the charge cards like they used to. In our personal finance, does a firm and those kind of companies, do they win?
I think the buy now, pay later replaced the credit card. And what I never saw coming was the fact that the merchants are paying the fees, right? They're paying a firm, they're paying. And so what happened in 2010, and not to get too technical, but the Card Act.
It's Friday, don't get technical.
When we were in college, we got solicited by every credit card out there.
Yes.
So when we graduated, we had credit card debt. In 2010, that changed. So unless you got a co-sign by your parent, if you were under 21, you couldn't get a credit card. So this generation of Gen Z and younger millennials aren't used to revolving credit. So they're actually buy now, pay later is more appealing to them, even though sometimes it's the same thing.
How do they set up a credit history then? If they eventually, when they want to start becoming consumers in this economy and be able to apply for loans, they don't have a credit history then.
That's exactly right. Because you're not, even if it's the high earners and they're taking American Express, they're paying down their balance. So you're exactly right. It's going to be harder for them to get a credit history.
I think of you and the Klan. I'm going to pick on Mike Mayo. We all love to pick on Mike Mayo. Great analyst out there. You people said they'd get through the great financial crisis and that we should own the banks as part of our retirement. Give us an update now on where you think in the next 10 years those successful investments, where do they go?
Well, it used to be the case that the banks paid rich dividends. That hasn't been the case. So banks have been buying back shares at really high valuations, which is not accretive for the banks. And they've been reticent to raise dividends because they don't know how long this great earnings bonanza that the banks are in is going to last. So I think they're better vehicles to buy outside of the banks that have rich dividend yields. In retirement, you can have both. Equities that have rich dividend yields. Bonds are less certain. The 60-40 portfolio hasn't been a great performer the last year. But I think banks... JP Morgan is an absolute outlier. I mean, since 2010, they've just been a juggernaut, and that's been a great stock. But they bought back the most amount of shares of any of the banks.